Joe's got all the business news for us today, and focus on BP, Joe. Yeah, absolutely. This BP story seems to be intensifying. BP's chairman, Carl-Henric Svanberg, has now been summoned to a meeting with President Obama next Wednesday in the White House. The US government is also considering legal action to prevent BP from paying dividends to its shareholders in order to ensure that BP, rather than US taxpayers, foot the cleanup bill. But the costs haven't just been environmental. Now, since April, BP's share price crash has almost halved the company's market value to £69 billion. Before the explosion and sinking of the Deepwater Horizon rig off Louisiana Coast, BP was worth more than £120 billion. 44% of that since BP's share price has fallen 44%, wiping a staggering £53 billion off its market value in just 7 weeks. And this all spells bad news for many of our pension funds. Why? Because £1 in every 7 paid to UK pension pots comes from BP dividends. Although we may not realise it, around 18 million people in the UK either own BP shares or pay into a pension fund that holds BP shares. Well, Rensberg Sheppards Investment Management owns 50 million shares in BP, and John Haynes is the head of research, and he is with us now. John, just tell us what the reaction of the markets will be to the news overnight that the chairman has been hauled over the coals next Wednesday, and that this oil spill could be twice as bad as we had originally thought.
I think that's what the markets have been telling you, that they are unsure that we've correctly dimensioned the size of the problem. That's why the shares have been coming down over the last month. In terms of the political nature of the issues, it is about time that they had a discussion with the US president about these issues, and I think that has to be naturally thought as a logical next step in the process.
Now, this dividend issue is very important. BP is very important for pension holders and for pension investment fund managers like yourself.
Yeah, but I think one needs to put it into proportion. First of all, BP is part of diversified portfolios, so it's part of a whole index of companies that pay dividends. Certainly, it's around 15% of the all-share dividends, but only around a third of the assets of UK pension funds are invested in the UK. They're also invested in overseas equities and also in gilts and fixed interests and a number of diversifying assets. So if you adjust for all those factors and you suggest that maybe BP cuts its dividend by half rather than passes it for a full year, the true impact on the income of a pension fund is probably around 0.5%, and that's overwhelmed by the natural growth in dividends that one's likely to see this year anyway. So I think one should not get this out of proportion. Just calm down a little bit.
Yeah. And yet there is talk that BP may not survive. It could actually be taken over.
At points like this where emotions run high, there is all sorts of talk. I think it's very unlikely that BP's existence is threatened. Currently, analysts believe that BP is trading at around the value of its assets, excluding America. So you're saying you're putting no value on the American assets. And from that base, I think it's more likely that surprises are positive than they are negative.
Thank you very much. John Haynes there from Rensberg Sheppards. We'll wait and see. In just over an hour, the stock market opens. Let's just see what BP share price does in reaction to that news overnight. OK, Joe, thank you very much for that.